American General Life Insurance Company, a member of AIG, is one of the most experienced writers of structured settlements with more than 40 years in the industry. Innovation is the key to our growth and led to the creation of the Interest Rate Linked Structured Settlement, or IRLSS. This is a structured settlement industry first and allows claimants to lock into future interest rates today. At the time of settlement, the claimant chooses to defer a portion of his or her proceeds into our interest rate linked structured settlement benefit stream. For this hypothetical example, we will be using $250,000 for the annuity premium. Now that the claimant has determined the amount, they have two questions to answer. First, when do they want the deferred lump sum paid to them? At the time the lump sum is due, if interest rates are the same or lower, the lump sum will be paid as scheduled. If interest rates increase, the lump sum will convert into a stream of predetermined payments. Second, what is the length of the benefit stream they would like the lump sum to convert to if interest rates have risen? In our example, they have elected the period certain to be payable monthly for 20 years. If interest rates rise, the lump sum automatically converts to a 20-year period certain, payable monthly. The 10-year U.S. Treasury rate on the date the case is locked for purchase is 2.5%. This is referred to as the initial reference rate. 60 days prior to the lump sum due date, the 10-year U.S. Treasury rate will be compared to the initial reference rate of 2.5%. This is referred to as the annuity benefit determination date. If the 10-year U.S. Treasury rate is greater than the initial reference rate of 2.5%, the predetermined 20-year period certain monthly benefit will begin on the original lump sum payment date. If the 10-year U.S. Treasury rate is the same or lower than the initial reference rate of 2.5%, the lump sum will be paid as scheduled. To summarize, if U.S. Treasury rates increase, the period certain benefit is paid. If U.S. Treasury rates stay the same or decrease, the lump sum benefit is paid. The claimant determines all benefit streams at the time of settlement. This sample proposal contains complete details of the lump sum payment and the period certain benefit selections we have just discussed. This table provides the detail needed when evaluating how U.S. Treasury rates will affect the IRLSS payout. Highlighted here are a range of 10-year U.S. Treasury rates. The rates in effect 60 days before the lump sum is due or the annuity benefit determination date will decide the benefit paid to the claimant and are illustrated on the chart for ease of reference. As previously discussed, if the U.S. Treasury rate is 2.5% or less, the claimant will receive the originally scheduled lump sum. If the U.S. Treasury rate has increased to 3.51% 60 days before the lump sum is due, the payout instead converts to the predetermined 20-year period certain. The monthly payment is $2,792.14. In this sample proposal, our chart illustrates the 10-year U.S. Treasury rates up to 4.76%. If the interest rate is higher, the monthly payment amount continues upward at the same rate as shown in the chart. There is no cap on the claimant's benefit payment. Probably the most important part of evaluating IRLSS is the break-even point and knowing what it is when presenting the quote. In other words, for this example, if the $250,000 premium was placed in a 20-year period certain today, deferred for 20 years, what would the monthly benefit be? Based on today's rates, the monthly benefit of that benefit stream would be $2,709.39. $2,709.39 falls between these two monthly benefits highlighted here. An interpolation between the two monthly benefits is taken and applied to the interest rate shown. With some simple calculations, it is determined that the 10-year UST would have to reach 3.15% to equal what could be purchased today with a standard structured settlement. That means the 10-year U.S. Treasury would have to rise 65 basis points from where it is today to equal what could have been purchased originally in a standard structured settlement. If the interest rate is lower than 3.15%, the benefit is a little less than with a traditional structure. However, if the interest rate is higher than the break-even, the benefit is more. Potentially much more, since there is no cap on how high the interest will be credited. If the 10-year U.S. Treasury is higher than 4.76%, the benefit steps will continue in the same increments as shown in the table. It is important to remember that since Earl's quotes are all daily rates, as rates decrease, the break-evens will be higher or less competitive. But as rates increase, the break-evens will improve. Please keep this in mind when looking at Earl's quotes. The break-evens can and will change from week to week. Throughout this video, there have been mentions of the reference rate. The reference rate is selected by American General and is determined by the length of the period certain that is selected by the claimant. The U.S. Treasury rate that most closely reflects the duration of the period certain is chosen. Currently for Earl's, period certains of 10, 15, 20, 25, and 30 years are offered. The corresponding reference rate for each is shown here. In the example, the 20-year period certain was chosen. When the duration for a 20-year period certain is calculated, it comes out to approximately 9 years. In comparison to all of the government-issued Treasuries bonds, the 10-year U.S. Treasury has the closest duration. Some guidelines to keep in mind when considering Earl's include: the lump sum may be payable in 5, 10, 15, or 20 years. There is an exception on minors' cases to start payments at age of majority. The period certain benefit may be 10, 15, 20, 25, or 30 years. If interest rates are higher, there is no cap on the increase. All quotes must be quoted as daily rate requests, so please allow extra time for this process. Attorney fees are accepted as long as a portion of the claimant's structured settlement is also placed with American General. Earl's is not approved for use in New York, nor is it approved for use with reinsurance or buy-and-hold annuities. The test case has been submitted to the IRS for a private letter ruling, and a response is expected soon. On any case that is sold prior to IRS approval, a letter of indemnification is available upon request. An easy-to-understand video is available that can be shared with your clients. Go to aig.com/IRLSS to access the video. This link is also included in the pricing update emails. The pricing update emails are an easy way to stay informed on Earl's pricing. You will be able to see approximately where the break-evens are for various scenarios without having to request a daily rate. If you would like to receive periodic updates, please contact a member of the marketing team to be added to the distribution. Earl's is a great way to diversify a settlement plan. Many traditional structured settlement quotes are presented in bond-type scenarios, monthly benefits for 10 or 20 years with a lump sum at the end. By putting all or even 50% of that lump sum in Earl's, it gives claimants the potential to extend their tax-free benefits at higher rates in the future. For claimants that are considering long-duration benefits, Earl's is a way to offer upside potential with a known limited downside risk. Please contact our marketing team for additional information. Thank you for your continued support.